Businesses streamline their inventory management process, reduce costs, and improve overall efficiency. Inventory accounting valuation and revaluation are not just technical processes, they are the lifeblood of a company's financial health. Inventory represents a significant portion of a company's assets, and how it is valued can have far-reaching implications. The methods of valuing inventory, whether cost-based or market-based, serve to provide a snapshot of a company's operational efficiency and financial viability. Cost-based valuation looks at the expenses incurred in acquiring and producing inventory, while market-based valuation assesses the current market conditions to determine the value of the inventory. In practice, businesses often employ a combination of both methods to arrive at a more accurate valuation that reflects their true inventory worth. When we talk about inventory, it's essential to recognize that not all inventory is created equal. It can be categorized into three primary types: raw materials, work in progress, and finished goods. Raw materials are the basic components used in production. Work in progress refers to items that are in the process of being manufactured, and finished goods are completed products ready for sale. Each classification carries its own implications for valuation and affects how a business manages its resources. Understanding these distinctions is crucial for making informed decisions about production, purchasing, and pricing strategies. The process of inventory revaluation is often complex and requires careful consideration of various factors. One of the first steps in this process is to clarify the purpose of the revaluation. Is it being conducted for financial reporting purposes, tax implications, or regulatory compliance? The purpose will guide the methodologies and processes that follow. Once the purpose is established, defining the scope of the revaluation is next. This involves determining which inventory items need to be included, how often the revaluation should occur, and the level of detail required. Choosing the appropriate valuation method is another critical step in the revaluation process. Common methods include first in, first out, FIFO, last in, first out, LIFO, and the weighted average cost method. The choice of method can significantly impact financial statements, as it influences the cost of goods sold and, consequently, net income. For instance, FIFO assumes that the oldest inventory is sold first, which can lead to higher profits during periods of inflation, whereas LIFO can help reduce tax liabilities during the same period by matching the most recent costs against revenues. Implementing robust processes and controls is vital to ensure accurate and efficient inventory revaluation. This includes restricting access to inventory data to authorized personnel, maintaining comprehensive records of all changes, and investigating any discrepancies that arise. By establishing these controls, businesses can mitigate risks associated with inventory mismanagement, ultimately leading to more reliable financial reporting. The implications of inventory revaluation extend beyond the balance sheet. They can significantly affect a company's income statement. For example, if a company must write down inventory due to a decline in market value, this will directly impact its assets and equity. A write-down from $100,000 to $80,000 results in a 20% loss that must be reflected in the income statement. Such adjustments can alter a company's financial ratios, affecting everything from creditworthiness to investor perceptions. One of the most critical concepts in inventory accounting is the net realizable value, NRV, which represents the estimated selling price of inventory minus any costs associated with its sale. This metric is essential for ensuring that inventory is not overstated on financial statements. If a company holds inventory that is no longer selling at its original cost, it must be written down to its NRV to reflect its true economic value. This write-down process is an essential safeguard against financial misrepresentation and helps prevent losses from obsolete inventory. However, the challenges of inventory valuation are manifold. Accurately determining the total cost of inventory can be complicated, especially for businesses with extensive or complex inventories. Using the cost of goods sold (COGS) equation, which factors in beginning, Inventory, purchases, and ending inventory is a common approach. Yet, this requires precise physical counts and an understanding of the value of damaged or outdated goods. The need for experienced accounting staff becomes evident, as miscalculations can lead to significant financial repercussions. As businesses navigate the intricacies of inventory valuation, they must also consider the impact of external factors, such as supply chain disruptions and market fluctuations. For instance, if a company experiences a delay in receiving raw materials due to a supplier's financial difficulties, it must evaluate how this affects its inventory levels and valuation. Similarly, changes in consumer demand can lead to overstock situations, necessitating a review of inventory values to avoid carrying costs and potential losses. The lower of cost or market (LCM) rule is another essential principle in inventory accounting. This conservative approach requires companies to report inventory at the lower of its historical cost or its current market value. By adhering to this principle, businesses can avoid overstating their assets and ensure that their financial statements accurately reflect their inventory's value. Furthermore, businesses often face the challenge of managing obsolete inventory. As market demands shift, products may fall out of favor, leading to excess stock. Companies must develop strategies for dealing with this obsolete inventory, whether through discounts, bundling with other products, or donations. The goal is to minimize losses while maintaining a positive cash flow. In addition to managing obsolete inventory, companies must also consider how to effectively handle inventory write-downs. This involves determining the need for a write-down, calculating the value to be written down, preparing justifications, obtaining management approval, and recording the write-down in accounting records. Monitoring inventory levels and adjusting write-downs as necessary is crucial to maintaining accurate financial reporting. Implementing best practices in inventory management is essential for preventing the need for frequent revaluations. This includes establishing clear inventory policies, prioritizing stock based on demand, and utilizing technology to streamline inventory tracking and management. By adopting a proactive approach, businesses can minimize the risks associated with inventory mismanagement and ensure that their financial statements reflect their true economic position. In conclusion, inventory accounting valuation and revaluation are critical components of financial management that require careful consideration and strategic planning. By understanding the various methods of valuation, the implications of revaluation, and the best practices for inventory management, businesses can navigate the complexities of inventory accounting with confidence. Ultimately, effective inventory management not only enhances financial reporting, but also supports overall business success by ensuring that companies can meet customer demands while optimizing their resources.